So in terms of startups, it actually should be, or based off of your net worth and investment horizon, a tiny part of your actual total investing portfolio. You can invest in so many different things from, stocks, with Robinhood, all of that, bonds, mutual funds. We all do list direct angel investing like Kevin does with larger check sizes. You can also be part of crowd investing through Republic with, investing as little as $10. You can invest in physical commodities like gold, real estate, alternative assets like crypto. We actually, on Republic, we do have some crypto offerings as well. And part of it should go to your retirement. The rule of thumb is generally 10% of your income. So based off of all of that, there's so many options to invest. And so the recommended average is 5 to 10% of your total portfolio. And that's just because it has to do with risk, right? At the end of the day, like, you do want some investments that, will generate the major portion of your revenue, but at the same time, you do want to make sure that you are diversifying your risk and then trying to play as well in some of those more riskier assets. One thing we do want to break down is kind of investing in startups versus stocks. Angel investments really differ from public companies in terms of liquidity. As Kevin mentioned, the average holding period is about 9 years. Once you have it, you're there. You are married to this company. Transferability, it's just hard to transfer, and the laws make it that way. Holding period, as we mentioned, is pretty long. And something that I did want to mention, coming back to the liquidity side, is that, you can't necessarily, trade it in for something else too. You have to, at the end of the day, stay with it. Risk profile, it's pretty high, right? This, once again, is an asset class that is known for being risky. And so if 9 out of 10 startups are failing, then you just have to have a really 10 out of 10 risk profile. And then reporting is pretty limited, right? It really just depends on the company, the founders, what's legally required. Not much. So at the end of the day, you just have to either figure out ways to get direct insight, either through the founders, or you might have to get updates. And so that's just something to keep in mind. But at the same time, the size of the stake could be much bigger than, like, say, if you just get a stock in the through Robinhood or something like that. This is a chance to actually go into a deal much earlier, and therefore, through your check size, be able to get a bigger portion of the company. Knowing the team, that is something that Kevin definitely stressed prior. And so that's something that through Republic, you can actually get a lot of information out of the discussion board. So if you go to Republic, under every deal page, there's actually a chance for you to ask founders direct questions, and they're pretty responsive as to how, what they're doing, being transparent. And so that's just something to keep in mind. You actually do get to know the team and the ability to help. We have companies that have raised a full $1 million on the platform, and we also had investors in those companies then go and angel invest later, or they were able to connect them with customers that were able to then be part of their pipeline. And so I think we had one, Sapient, that was able to generate $750,000 of secured commitments in their pipeline just because of a Republic campaign. Is directly attributable to that. So that's the whole portion of when we say that it is not just fundraising, but also marketing, because you are acquiring new customers, engaging your current customers, and that's something that's major. Access to growth markets. Once again, this is something that, you don't necessarily have access to prior. And so now with the new legal changes, this is an area where, once again, high growth, high potential for return. And that's the last one. So in terms of how to actually build your portfolio, we will cover this in depth in the next masterclass next Tuesday at 2 p.m. Eastern. So this is just a kind of a preview, but really a thesis, investment thesis, is making a thesis that resonates with your investment strategy and helps you stay focused on your objectives when investing. A thesis will do the following for founders. So making sure that you're the right investor for them based off of your prior experiences, based off of what, like Kevin said, like what you imagine, life to be 10 years out, how you will work for them post-investment. You can be an active or a passive investor. Previously we did mention that, if there is a company that just needs the money and you to stay out of the way, that might be the time for you to just take a step back. But at the same time, you do want to provide value add. Kevin has a document that literally says, here's how I can add value to your company. Or in that prior example I mentioned for Republic, it is, okay, I invested in this company and I also have a family member that might become a customer here. I can make the connection. Those are the types of things that I think angels in general want to be cognizant of. And then what information you'll be asking from them, that's just because based off of your thesis, you have specific priorities. And so, things that you want them to capitalize on, because those are the things that are going to get them exponential growth. And then last but not least is better communication with co-investors. And so that just means that if you have a great thesis and you are aligned with other co-investors, you might be able to do deals later on as well. So that's just a little teaser for what we're going to go into. And we actually have already started creating that deck. That deck is a lot more quantitative. It's a lot more structured in terms of giving you models to think about how you go about your thesis. So get excited for that one. Asset allocation strategy. So a lot of questions are about how many investments should an angel make to build a diversified portfolio. This is a caveat, right? We generally say between 10 to 28 investments, but as I mentioned prior, it's just large numbers, which essentially means that the more investments you do, the greater the chance that you might be able to get a return. And so something here, I don't know if a lot of people are tech folks, but that's the reason why 500 startups is called 500 startups. It's at the end of the day, they're trying to maximize the returns they're trying to get. And so here's a chart as to how, people are seeing returns based off of the amount of investments that they're making. Something to stress here is the importance of diversification. Kaufman Fellows actually came out with a report in December of last year that said investors could benefit from indexing as broadly as possible at the seed stage by putting money into every credible deal, because any selective policy for seed stage investing will eventually be outperformed by an indexing approach. And so something that I think Sandra actually put in the chat is a link to Republic Autopilot. And so we can go into that later when we have a little bit of a Republic demo at the very end. So, but the key aspect here is every credible deal. And so as I mentioned on Republic, right, we do a lot of due diligence. We make sure that these companies are in fact credible. And so that is something to keep in mind, and you will be able to diversify through Autopilot. Diversification is key here because it helps you minimize portfolio risk so that you don't put all your eggs in one basket and only invest in the same types of deals. You want to make sure that you diversify in terms of the quantity of investments, the industries or the sectors, stages, maybe pre-seed, seed, series A, types of founders and teams. Kevin did talk about several examples on that front, and also types of risks, maybe there's a founder that's only focusing on the product. There's another founder that's only focusing on the team, trying to make sure that you diversify in that sense. And looking for also diversity. I know in the chat, there's a lively discussion about how, there's a lot of companies that may be run by underrepresented founders. And so making sure that you kind of keep that in mind, genders, race, age, education, not everyone has to go to Ivy League, right? Making sure that you do take all that into account, because at the end of the day, it also helps you. So finding great companies. Kevin definitely walked us through this, but just to reiterate, creating a network is key, making those connections. I've already seen those LinkedIn requests coming through, talking to other investors about co-investing opportunities, finding angels to discuss your strategy or status, experts in certain fields. That's something that's we feel like that's a great way to start getting deal flow that way. And then last but not least is asking maybe public venture partners in our weekly Ask Me Anything switch. So make sure to follow us and you'll have access to those as well. And Republic, once again, curates anywhere from 20 to 50 deals on the platform at any given time. And so that's also just a great way to scout. So at the end of the day, a strong network and referrals fuel angel investors. And then once you've angel invested, what do? You can do nothing, which is totally fine, depending on whether you're active or passive angel. But I'd say depending on the type of investor you want to be, you can either connect with the founders and then with other investors. So you've now invested, send them to a couple of your buddies, and I'm sure that they'll appreciate that as well. Advise a team. Kevin, as part of his value adds, he advises them on sales, on OKRs, all the things that he has a very strong background on. Mentoring the team about fundraising, next steps, and then strengthening the relationship between the founders of yourself. That is something that's key because you also want to keep them in mind. You want them to keep you in mind, actually, so that when the next round does come through, you might have a chance to increase your pro rata or, even just be part of the round. Yeah. And then this is an example of a diversified portfolio on Republic. Once you join Republic and you start investing, you actually do get a breakdown just like this that shows, what kinds of companies you're invested in, how many companies you've invested in for the year, and what types of sectors, and kind of giving you a great sense. Like here, you can see the diversification is excellent, right? Like this is a great way for you to kind of get a better sense and a clear clear portfolio view of what you are investing in.